system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Hi, Manisha Petula. This is Jugal from SKP. We are live. Would you like to begin, please? Manisha Petula. Hi. Can you hear us? We are live.
Yes, we can. Hello. Hi, Parag.
Hi, Petula. Good morning. I think you can begin. We are live on the webinar.
Okay, great. So, good morning, everyone, and good afternoon to those in Australia. So, we're very happy to be working with SKP on this to organize a webinar for our members to hear about the key insights on the Union Budget of India 2020 to 2021. So, as you know, the Finance Minister, Nirmala Sitharaman, on 1st February 2020 spoke about the Union Budget, and we're very keen to have views from our experts on this. ANZ has been a member of the Chamber for quite a number of years. My apologies that Sanjay Mathur, Chief Economist, Southeast Asian India, couldn't make it today. He had to pull out the last moment due to unforeseen circumstances. However, he will be sending across his views, which we will share with you along with the recorded webinar and his key insights, giving us a macroeconomic perspective. Having said that, we have Nishit Parekh, who is practicing chartered accountant from SKP, who will be talking about the macroeconomic view, and then we'll move on to direct tax implications, indirect tax implications, and we'll have an opportunity for members and those who are attending to ask your questions and make any comments that you have. So with that, I'll now pass on to Nishit. And Nishit, we're waiting to hear from you. Thank you very much.
Thank you, Petula. Good morning, everyone, and good afternoon, everyone in Australia. I would be taking you through the macroeconomics, and what proposals the government proposed in this budget, and also the direct tax amendment. In case you have any questions on any tax or any other aspect, you can just type it down in the dialog box, and then we can answer it at the end of the webinar. So to begin with, the government emphasized 3 cornerstones for this budget. One was Aspiration India, whereby the main objective was to give access to health or insurance to everyone. Education was one of the important focus area where government wants to make India as an education hub. And third was the employment creation. With the recent slowdown in the economy and the way things have been, employment creation and generation was one of the important factors which government very briefly spoke about. Second was government committed on its economic development reforms. They are committed to continue the economic development which they have been doing from last few years, and they also mentioned about having a caring society where a human approach is adopted, taxpayers are respected, wealth creators are respected. That was the cornerstone of the entire webinar. From the economy perspective, key highlights of the budget were India moved to the fifth largest economy in the world, and there are aspirations to move to third largest economy in few years. Also, India currently is the third largest economy in terms of purchasing power parity. The FM mentioned that India is targeting 10% nominal GDP growth over the next few years. Also on the fiscal deficit side, with the huge tax cuts which were announced in September 2019, whereby corporate tax rates were reduced by 10% roughly for all the corporates, there was a scare that fiscal deficit slippage would be there, but government has committed to a fiscal deficit of 3.8% for financial year 1920 and a very optimistic number of 3.5% for 2021. So mainly the target, the government looking to meet the target through disinvestment of the large public sector companies like BPCL, Concor, and also they are looking at one big announcement which came through in the budget was disinvestment of LIC, that is the Life Insurance Corporation of India, and that could be a big one because LIC is a huge corporation in India, and that disinvestment could yield substantial money to the government. Government has committed to a total spending of 30.4 trillion the next year. On the infrastructure bit, government mentioned that already 15,500 kilometer work has been done on the highways. They also mentioned about electrification of all railway tracks, whereby 27,000 kilometer of railway tracks have been built. Focus on agriculture has been there, whereby 15 trillion credit target has been pronounced for 2021, and also a good scheme for around 2 million farmers to be covered under the solar pump scheme has been announced. Education, as I mentioned earlier, would be the focus point. Government mainly mentioned that to promote that education, they will come out with a new education system and a policy very soon, and also to have the funding, relevant funding for the entire education sector. They will give or incentivize investment into the education sector by liberalizing or by tweaking the external commercial borrowing norms and foreign direct investment regulations. So mainly whatever foreign flows coming through either by way of foreign loan or through foreign equity, they would streamline and make it easier for people to invest in education sector. On the MSME side, the biggest announcement was on the Nirvik scheme, whereby exporters would be provided higher insurance cover to ensure that export is promoted from India, and also handholding support for technology upgradation and R&D businesses. On the financial sector, deposit of insurance cover has increased from the bankers. So there were recent couple of incidents whereby some bank had defaults in India, which were mainly on the cooperative bank side, but not any public bank has defaulted. But still, to ensure the faith in the banking system, the minimum committed deposit return, which the government will make in case of any default has been increased from 100,000 rupees to 500,000 rupees. MSME debt restructuring is on the anvil, and it has been extended to 31st March 2021. And as we spoke about, LIC disinvestment would be one of the biggest thing which government is planning for next couple of years. Also, in order to promote inflow into India, the corporate bond limits for the foreign portfolio investor, earlier known as FIIs, have been increased to 15% from current 9%. So this was a very broad overview on the macroeconomic situation. And now moving to direct tax proposal. So this year's budget had many changes, and we will take up all the changes what were announced on the direct tax side. One of the biggest expectation from the budget was expectation from the common man on the tax rates, because there was a big cut on corporate tax side, and there was huge media reports. In fact, even government reports or government minister speaking in some forum saying that we are looking at corporate the tax rate cut for individuals. Mainly, there was a need to give more income to an individual so that the spending increases and the economy starts flowing again. So in line with that, they have amended the tax slab rates for individuals. However, they have made certain twists in the entire scheme, and which has slightly made it more complicated than simple. But currently what it is that they have proposed new tax rates whereby up to 5 lakh, that is 0.5 million, 0.05 million, it remains 5% for everyone. But post that, if you are going in the new scheme from 500,000 to 750,000, you get 10% in the new regime vis-a-vis 20%, and from 750,000 to 1 million, you get 15% in the new regime vis-a-vis 20% in the old regime, and so on and so forth. But one twist which they mention is that if you are going under the new regime, then you would not be allowed of any deduction which you were claiming as a salaried person or as an individual. So the deduction could be a standard deduction which you would be claiming from your salary, or it could be a house interest deduction which you would be claiming on your housing loan, or a house rent allowance you were claiming if you were staying on rent, or a certain investment deduction under ATC which was for your LIC or your deposit in some fixed deposits. All those would not be allowed if you opt for the new scheme. And also they have said that this option of choosing between the old regime and the new regime would be available to the taxpayers, and that taxpayer will have to take a call every year on which regime it wants to follow. Only for individuals who are having business income would have to select this option only once, and post that he will have to follow whatever option they select. And one more important change which came out in the budget was the social security contribution, which was which was very minimal in India. If you are making in excess of 0.75 million, then the additional contribution which you are making would be treated as a perquisite. The employer's contribution would be treated as a perquisite and would be taxed in the hands of the employee. And also any accruals or interest on the social security contributions over and above that 0.75 million would also be taxable as a perquisite. Earlier this was not taxable, and government was of the view that the advantage of making higher contribution to social security would be taken only by the rich people, and the poor people were not getting that advantage. So if they are getting an advantage, they should get taxed, and that's why this tax has come in. So if we look at how the new tax rate compares to, we've taken a couple of examples to explain which regime would be better, whether you should go in the existing regime or the new regime. So if you are mainly claiming standard deduction, the entire ATC deduction, that is investment linked deduction, and also a deduction on the medical insurance plus the housing interest deduction, then it is very clear that the old regime is useful. New regime is not useful at all, because the differential tax is way higher in the new regime. But only if you are claiming standard deduction, ATC deduction and ATD deduction, that is medical deduction and investment linked deduction, and no housing allowance, you are claiming either housing loan or HRA, then new regime is beneficial. Go for. And lastly, if you are claiming HRA also, then again the old regime becomes beneficial. So in a nutshell, if your deduction is anywhere between 2,30,000 to 2,50,000 INR, then the old regime is higher than 2,30,000 or 2,50,000 INR, then the old regime would be useful and new regime would not be useful. Only if your claim of deduction is lower than $2,50,000, then you will have to think through whether you want to go to the new regime, because it would be more helpful in terms of saving taxes and increasing your cash flow. One more big change which came about was on the residency law. So India typically treats individuals as resident in India based on the days which you spend in India. So earlier, for Indian citizens who were going outside of India, when they were coming back to India, either for their social functions or for their personal work, they were allowed to stay in India for 182 days before becoming a resident in India. However, that limit has now been reduced to 120 days, and also in India, a resident and not ordinary resident. There are concept of you being an ordinary resident, you being a resident but not ordinary resident. So in cases where you are a resident but not ordinary resident, only your Indian source income is taxable. But if you are a resident and ordinary resident, then entire global income wherever you earn outside of India is also taxable in India. So earlier there was a twin condition whereby in order to become ordinary resident, first you need to satisfy the presence test in India, and then in last 2 out of 10 years you need to be a resident and you should be in India for 730 days in last 7 years. That was the two twin conditions which you needed to satisfy to become an ordinary resident. However, now the first condition of 730 days has been removed, and the other condition of 2 out of 10 has been made 4 out of 10. So if you are spending say more than 120 days and you are an Indian citizen spending more than 120 days in India and you are a resident in last 4 years out of the 10 years, then you become an ordinary resident and your global income becomes taxable in India. Then one of the big change which actually created a controversy was that taxation of a stateless resident. So India came up with a law which said that if an Indian citizen who is outside of India and he is not paying taxes in any of the countries, then he would be considered as a resident of India. So this actually created a huge uproar because a lot of people are in countries like UAE, Saudi Arabia, where actually there are no taxes and they are bona fide workers there. So there was a interpretation which led to believe that their income, even though they are not coming to India, may get taxed in India. After this uproar, the government came with a clarification on Sunday itself, but the clarification unfortunately is not clear. The clarification states that the amendment's intention is to tax only the Indian source income of these guys and not the foreign income. But that was the case earlier also when the law was not amended. So then what was the need of actually amendment of the law? That is not clear. So we are hopeful that till the time the budget gets approval from the Lok Sabha, the appropriate changes on this law would be made by the government. Some tax incentives provided were to promote housing sector. Affordable housing projects approval has been extended to 31st March 2021. So even affordable housing projects which get approval up to 31st March 2021 would be liable to get 100% tax holiday. So as I mentioned earlier, India has now become attractive in terms of a foreign investment jurisdiction because for new manufacturing units which are set up into India post 30th September 2020 and up to 2023 get a favorable tax rate of only 17%. So that favorable 17% tax rate was available only to manufacturing companies, and now that benefit has been extended to companies who would also be engaged in business of generation of electricity. And one more benefit given to sovereign wealth funds. If they are looking to invest into India, they would have exemption from their investment income subject to lock-in period of 3 years. Then India amended the provisions of Section 90. Section 90 mainly provides power to Indian government to enter into tax treaties with various governments. So earlier the objective of the tax treaties was to ensure that there is no double tax to a resident of either of the country to ensure that there is no double taxation. However, now they said that the treaties would be entered into in such a manner that not only it will take care of double taxation, but will also ensure that because of the treaty, someone is not getting undue tax benefit. So this is in line with what the BEPS project is recommending, and that's why this change has come about. And one of the biggest amendment and one of the most cheered amendment for foreign investors was exemption from filing tax return. So any foreign company who was earlier earning any income from India, say service income or royalty income, was liable to file a tax return in India. But now the government has said that if any foreign company is earning any interest, dividend, technical services fee or royalty income and taxes are paid as per the Indian laws, not the treaty laws, then it would not be required to file a tax return in India. So for example, if an Australian company has set up an Indian subsidiary and it is allowing that Indian subsidiary to use its brand name and charging a brand name royalty, then the rate provided under the tax treaty is 10%. But if they agree to pay tax at 10.92%, which is the Indian tax rate, then they would not be required to file a tax return in India. And same way for service income, if they pay tax at 10.92% in India, they would not be required to file a tax return in India. However, there may be cases where Australia-India treaty is favorable in terms of it allows benefit of make available, and many Australian companies who are providing services to India are not offering it to tax to India because of the beneficial provisions of the tax treaty. In those cases, the tax return filing requirement would continue. Also, there is no corresponding exemption provided on the transfer pricing regulation. So if it is a transaction between two related parties, then the transfer pricing provisions would apply. And one of the important points to be looked at from an Australian perspective is that if the Australian company is paying a higher tax in India that is over and above the tax treaty rate, then whether the tax credit of the additional 0.92% paid in India would be available to them as a tax credit in Australia or not. My first view is it should not be available, but this needs to be verified from an Australian law perspective to see that, and basis that a informed decision needs to be made whether a cost benefit analysis needs to be taken whether it is advisable to pay that 0.92% higher, or it may make sense to save that 0.92 and actually file a return in India. Further, India has introduced thin capitalization, something similar to a thin capitalization rule, whereby interest paid on foreign loans was not allowed up to a certain limit. And in that, they have now provided exemption to loan taken from any banking branch of a foreign company which is in India. So like an ANZ India branch, if you take a loan from that bank, then there is no this provision of thin capitalization would not be applicable to you. Further, in line with the BEPS project, India had introduced significant economic presence which looked at taxing digital transactions in India. However, since the OECD and the BEPS are itself coming out with a final report on what are the measures which the country should adopt, and that report is expected anytime this year. So in line with that, they have deferred the SEP regulation by 1 year. But at the same time, they have included three main items under the source rule of India. That is that if anybody is targeting Indian customer through advertisement, even though those advertisement is from outside of India, that would be considered as having a source of income in India and may become taxable in India. But obviously, this is an amendment in the local law, so the tax treaty protection would still be available. Sale of data collected from India and used for selling goods or services in India is one more. So to give you a very simple example, so if someone is doing a market research, say for example for a soft drink, or and they are doing a collection of data from India on what is the preference of Indians on drinking a soft drink, whether they like it sweet, salty, and basis that some product is prepared and sold into India, that may come under the net of this new amendment. Further, there were certain exemption provided for cinematic royalty earned from cinematographic film that has now been removed to make it in line with other definitions. Further, if any funds which are having Indian fund managers, so say for example Australian fund which is investing into India and they have a fund manager in India, so there certain couple of conditions have been relaxed. So only 5% investment from Indian residents was allowed in that fund if the fund manager was in India. But now they have said that investment up to 250 million for first 3 years, if it is made by the fund manager itself, would not be counted in that 5% limit. And they need to reach a minimum AUM of 1,000 million, which they have to satisfy up to 12 months. Earlier, the condition was 6 months. Now they have increased it to 12 months. One of the biggest change, one more biggest change was removal of dividend distribution tax. So earlier in India, what was happening if any company was declaring a dividend, the Indian company was required to pay a tax of 20.56% on the dividends declared, and at the same time, the foreign company or the Indian shareholder who is receiving the dividends, there was no tax payable by them in India. However, this had created a problem for many foreign investors, because since the dividend distribution tax was paid by the Indian company, they were not able to claim tax credit of the same in the foreign country. And also for Indian resident, last year a dividend tax was introduced. So for Indian shareholders, resident shareholders, it was creating a three-layer tax, whereby the on the profits the company was paying corporate tax, then the company was paying dividend distribution tax, and ultimately when the individuals were receiving that dividend, they were paying additional 10% tax. So that 10% tax rate also has been removed. So now the tax would be in the hands of individuals and companies at the applicable rates. So for individuals now, for high net worth individuals, the tax could go up to 43% for dividends, and for companies it could be around 25%, and for LLPs it could be around 35%. For foreign companies or foreign investors, the tax rate would be either as per the tax treaty or as per Indian local laws, whichever is beneficial to them. So we will first I'll take that slide. So if you look at the situation for Australia mainly, so if an Australian resident is having shares in an Indian company and he receives a dividend, he would now be liable to pay tax only at 15% as per the tax treaty, as against earlier when the Indian company was paying at 20.56%. So there is a clear saving of 5.6%, and also this 15% would be creditable against the dividend income which it is offering to tax in Australia. However, if you look at countries like Hong Kong, the tax rate for dividend is only 5%. So now Hong Kong may become a good jurisdiction to have it as an holding company structure for many companies, or UAE or Netherlands or Germany. But there are anti avoidance rules in India. So before creating any structure, those regulations would have to be looked at. And coming to this slide, and in order to ensure that the collection of tax on the dividends is on a timely basis, government has simultaneously enforced a withholding tax on the company. So the company would withhold tax at 10% when they are making payments of dividend in excess of INR 5,000 to residents. And for non-resident, it would be as per the tax treaty rates or the rates which we described in the next slide. Further, mutual funds also, dividend is now taxable at 10%. Because of the language of the budget, there was a controversy that whether tax would be deducted even on the redemption of mutual funds, but government has clarified the tax will be only on the dividend income from mutual fund and not on the redemption of mutual funds. Some improvements have been done for the startups. Some tax holidays has been, so startups were enjoying 100% tax holidays for 3 years from the setup, and that tax holiday had to be claimed up to 7 years. But there was demand from the startup that it takes some time to become profitable, and hence to increase that period of 7 years. So now it has been increased to 10 years. So now startup can claim exemption in any 3 years from the first 10 years of operations. So that's a good move. And also startup, as we are all aware, the turnover or the sales of the startups are always high, but the profitability is low. So earlier the qualifying criteria for a startup was only a turnover of 250 million, which has now been raised substantially to 1,000 million, so that more startups can qualify under this beneficial regime and can claim the tax holiday on the profits. One more important change is if you look at startups, many startups look at bringing the stalwarts of the industry into startup mainly to promote their business and also get business ideas. But they are not able to make a comparative compensation to them, and mainly they look at the ESOP route to remunerate those leaders whom they hire. And in those cases, what was happening for the leaders was, while the company may become profitable after many years, they were required to pay tax on the ESOP in the year of exercise of ESOP. So in order to help that situation and ensure that appropriate cash flow is available to pay the taxes, government has said that the tax can be deferred for the 5 years once you receive the ESOP, or if you sell such shares, you pay tax then, or if you leave the company, you pay tax then. Whichever event happens earlier, you are required to pay tax on the same. Then certain, in order to promote foreign investment into India, certain benefits have been given mainly on interest payments. So earlier when FPIs or FIRs were investing in Indian bonds or Indian foreign currency loan, a 5% rate was available. Taxation rate of 5% was available up to July 2020, and rightly so now that has been extended to July 2023. Further, municipal bonds have been added as a category in the bonds. So now municipal bonds also would be open to FPIs and QFIs to invest. Further, if you are investing in certain specified bonds and earning interest income, and this bond should be listed on the International Financial Center, which is built in Gujarat in India, then the withholding tax or the tax rate goes further down to 4% instead of 5%. Withholding tax rate for professional fees has been, sorry, for technical services other than professional fees has been reduced to 2% from 10% in the local domestic context. Certain benefits have been given to cooperative societies. One of the big change was on the withholding tax provision. So earlier, e-commerce players currently have come into limelight because a lot of sales have started happening on the e-commerce platform in India. So in order to ensure that the sellers who are listed on the e-commerce platform are carrying out tax compliances in India, now it is proposed that the e-commerce operators would withhold tax when they are making payment to the e-commerce operator. The withholding tax is kept at a nominal rate of 1%, and in case you don't have India tax registration number, the tax rate may go up to 5%. So mainly the customer, whoever, say for example, buys something on a Uber or takes a service on a Uber or buys something on Amazon, whatever amount the customer pays to that Amazon or Uber is required to deduct tax and pay to the ultimate seller of the services before making that payment. Two other provisions mainly to ensure or check whether appropriate compliances are happening or not have been introduced, or rather three major things are happening. So as per Indian government's data, lot of individuals in India are sending out money outside of India for investments, for foreign currency expenses, but the government is of the view that the appropriate compliance they are carrying out on the tax side, or they are reporting those income on the tax side, is not sure. So in order to track them, now if any investment is made by an Indian resident under the liberalized remittance scheme, which allows remittance outside India of $250,000 every year, then the banker who is making this remittance would have to withhold tax on such payments at 5%, and this 5% can be claimed as credit by the sender of the money in its tax return. And this is mainly done to ensure compliances in India. Another big thing, people in the foreign travel in India has increased very much in last few years, and government feels that there are a lot of people who are traveling abroad and a lot of disposable income. However, correspondingly, they are not reporting their income in the tax return. And in order to capture those kind of people, also to ensure government has appropriate data, they have imposed a tax collection at source by the tour operator if someone is buying a ticket or booking a tour package. Only issue in the entire thing is what happens if someone is going outside of India and using an international credit card. How the compliances are going to happen, who is liable to do the compliances is not clear currently. Further, one more question which we think should be answered is that currently the limit of $250,000 is provided by RBI, whereas the TCS provisions have been provided by the government. So is it that I can remit only $250,000 minus 5%, or 5% has to be over and above the $250,000? In our view, it has to be over and above the $250,000, because as per RBI regulation, I am allowed to send $250,000 outside of India. So the TCS, if any, has to be over and above that. One more thing which came as a big thing was, if you are selling goods to any buyer in India, in order to ensure they are also compliant, if you are making an sale which is exceeding INR 5 million, then you are required to collect a TCS of 0.1%. And this TCS of 0.1% would only be on the excess of the 5 million. So if you have 5.1 million sale to someone, then on 0.1 million you are required to withhold 0.1 million. Again, the objective is that India has only 4% taxpayers, or 4 to 5% taxpayers, whereas the disposable income and the spendings, if we look at, by and large everybody has money to spend. So the government is trying to track people who are doing a lot of business but not reporting in their tax return. And unfortunately, due to the non-compliance which is there in India, to enforce compliances, they are resorting to withholding tax and the TCS provisions, which will compel people to be compliant, and which I believe in long run would increase the overall tax base of India. Moving on, one of the very big thing which was announced was providing a taxpayer's charter in the statute itself. So this will give rights to the taxpayer against the tax authorities. So if there are certain timelines which are required to be followed by the tax officers, and each they are not following the same, this charter would give you the rights or the legal recourse on how to actually enforce that on the tax officer and ask him to carry out those changes. Further, faceless appeal proceedings has been proposed. So India, in order to curb corruption, was looking at delinking the face-to-face interaction between the tax officers and the taxpayers. So as a pilot project, it started with the assessments or the revenue audits which happen at the first level. And now they want to move the entire scheme of faceless appeal or faceless assessment to the second level of the proceedings. One more law which came, which I think definitely would be challenged by someone in the court, is that you need to pay minimum 20% penalty before going and requesting for a stay of demand if you are under litigation. So that is one change. And also one very important or a big change which has come is on dispute resolution. So government has come out with a scheme, as India has more than 500,000 cases pending at various appellate levels. They have come out with a scheme whereby they have said that if you have any cases pending before 31st January 2020 and you come and pay only the disputed tax amount, then we will waive off the penalty, waive off the interest which is chargeable on that tax, and we settle the matter. So this is mainly the idea of this is twofold. One is to reduce the backlog and the multiple litigation going on at various level, and second is to unlock a lot of revenue potential whereby a lot of cases may get settled and tax collection would be preponed. This scheme was notified just yesterday. Mainly it is in line with what the government said, that you need to just pay the tax demand and no interest and penalty would be levied on the case and the case would be closed. The timeline for paying the tax is 31st March 2020. But if you pay up after 31st March 2020 but before 30th June 2020, then you will have to pay additional 10% so of the tax amount. So if your tax is 1 million, then additional 0.10 million would be have to pay. You will have to pay if you are paying between 31st March and 30th June. And post 30th June, the window will close and it would not be available to anyone. And another few other miscellaneous provisions were creating penalties for people who are engaging into fake invoices. Safe harbor limits. So earlier, if you in India, if you sell a immovable property, say below the reckoner, that is the stamp duty valuation, then your sale consideration is replaced by the stamp duty valuation. But with the property price falling, the government has recognized it and said that you can the 10% variation between the sale price and the ready reckoner price would be allowed. Tax audit is an exercise which an auditor carries out on the books from a tax perspective, and it was over and above the statutory audit as per company law which was carried out. Now that tax audit threshold limit has been increased to 5 million from 1 million. So many small SMEs who are falling between 1 to 5 million will get a relief. However, this exemption is available only if your transaction, 95% of your income as well as expenses transactions are non-cash. That is, no cash transactions are allowed if you want to claim this benefit. Further, due dates for filing tax return has been extended. So now the scenario is that if in your company transfer pricing provisions are applicable, the tax audit and transfer pricing due date would be 31st October and tax return due date would be 30th November. In cases where transfer pricing is not applicable, then the tax audit due date would be 30th September and tax return due date would be 31st October. This is mainly done to ensure that when you are filing the return, all the data from the tax audit and the transfer pricing report is captured and you get the entire data pre-filled in the tax return. So the filing of the tax returns becomes simpler and easier for the taxpayers. And I think so with this, I end the direct tax proposal. Post the webinar, I would be happy to take questions if any. Now I would pass on the battle to Shivendra, who is my colleague from GST and the indirect tax team, who will take you through the indirect tax proposal. Shivendra.
Thank you, Nishit. We will be looking at the indirect tax proposals here. Mostly this will cover GST and customs. So GST, as we all know, most of the changes under GST are outside the scope of the budget, and they are usually taken up by the GST Council, which is a body comprising of states as well as the center which takes most of the decisions under GST. However, under this budget also they have introduced certain legislative changes, important ones, which were approved by the GST Council earlier. So to begin with, the first change is mostly a procedural one because of the reorganization of the Jammu and Kashmir state. Now, because Ladakh has been hived off from the Jammu and Kashmir state and made a union territory, the necessary changes have been made so that the union territory GST can be levied in that state. Moving on from that, the second important change here is the input tax credit and the time limit of taking input tax credit on the debit notes. So whenever a SSC used to raise a debit note on a recipient, the time limit, so this was a lacuna in the law which reduced the time limit to take input tax credit on a debit note. This has been sought to be rectified in this budget, and the time limit is now recognized from the date of issuance of the debit note rather than from the date of issuance of the invoice. Second change on the invoice front is that the government has also empowered itself to make rules to prescribe the manner and time for issuance of invoices for certain notified categories of persons. So we have already a provision for relaxation of provisions in relation to issuance of invoice for certain sectors such as banking and financial sector. Government has thought it necessary that for other sectors also, mainly e-commerce, the rules which will be notified later, they might want to relax the matter and time limit for issuance of the invoices. So this is an enabling provision which has been brought about here. Going ahead, so for certain offences that are committed under GST, certain penalties have been prescribed for various offences like supplying without invoice or invoice issuance without any backup supply. Mostly these offences were committed by the supplier of goods where fraudulent supplies were shown or fraudulent invoices were raised, due to which and the punishment under this was only applicable on the person who is committing such offense, that is the supplier of goods. However, government thought it necessary that many a times the frauds may be collaborative in nature, and also the recipient of goods who is availing input tax credit as a result of such invoice also needs to be made liable. So the change here has been brought about that a definition of person committing offense has been expanded to include any person who retains the benefit of a fraudulent transaction and whose behest or instance such transaction is done. So net effect of this change is that even the recipient or the person who is availing input tax credit could be made liable to penalty on any such offense that is committed. Then again, another provision which is under section 132, which is a stringent provision, which is for mega frauds, so to speak, where frauds committed are more than INR 10 million. In this case, also a lacuna was there where there was no offense, there was no penalty that was prescribed for an offense where input tax credit is taken without any invoice. So there was a penalty which was prescribed for an offense which constituted availing input tax credit on a fraudulent invoice. However, where no such invoice itself was in existence, there was no such penalty. This has also been brought about. This lacuna has been corrected, and the recipient who is availing such credit will be now made liable to punishment. The time limit for transitional credit. So transitional, when India transitioned into the GST from 1st July 2017, the law provided for availing tax credits which were lying in the balances under the earlier law. There was a time limit, however, of up to 31st December 2017, up to which the taxpayers could claim such carry forward credits from the earlier law. There was a lot of litigation in this front that the law never provided for any time limit, and only the rules from a backdoor sought to impose a time limit. So many taxpayers were suffering on that account, and courts were intervening time and again to relax the time limit. However, government thought it fit that that the time limit should not be increased for availing transitional credit, and hence they have brought a retrospective amendment to empower the government under the law itself to restrict the time limit to avail any transitional credit. Also a procedural change where there is a provision where government could time and again intervene to relax certain provisions or to remove difficulties under the GST law. The GST law being nascent in nature, this is only 2.5 years since it has been introduced. So the government has again changed this provision so as to increase the power that it has to remove any difficulties from the existing 3 years to now up to 5 years. Besides the GST changes, there has also been significant announcements that have been made by the Finance Minister, which are of equal note, if not less, than the other legislative changes. One of them being the introduction of system of cash reward for the ultimate consumers, so that so customers can be incentivized to seek an invoice. this is a measure to curb the practice where the retailers usually evade tax by not issuing invoices, and where the customers also participate in this system where no insistence is made on the part of the customers to get an invoice from a supplier. So the system of cash reward is envisaged to be introduced to correct this practice. Again, Aadhaar-based filing of return is being introduced where the modalities of this scheme are yet to be notified, but the unique identification card which has been issued by the government to each and every individual will be used for ease and simplification of the method of procedure of filing returns. Another significant change for the exporters is that government has already announced a scheme whereby exporters will be incentivized by way of refund of certain taxes. Now, these taxes, the exporters were suffering on account of no credit or refund being available, and these were embedded into the supply chain. So many taxes and duties, in spite of introduction of GST, still remain outside GST and are separately leviable. Most significant amongst those are agriculture taxes, taxes on electricity, and taxes on fuel. Presently, there was no mechanism to compensate the exporters on account of sufferance of these taxes. The government has now envisaged a scheme where these taxes will be refunded to the taxpayers, and this scheme will be known as remission of duties and taxes on exported product. The announcement is that this scheme is or will be introduced within this year itself. Another important announcement is the e-invoicing. So the e-invoicing provisions have been introduced in the GST rules, where again this is already announced and slated to be introduced in a phase-wise manner, which says that from 1st April 2020, taxpayers having turnover of more than 100 crore would be required to have an e-invoice for all the B2B supplies. This again is a method whereby government is trying to curb the practice of fake invoices, and so that all the invoices are populated on the government portal, and also the return filing mechanism and the auto population of invoices in the returns will be made simplified. This announcement has also been made that this will be introduced from 1st April 2020. Also from 1st April 2020, another significant measure which is already announced is the implementation of simplified returns. That also government has announced that will be made effective from 1st April 2020. Coming to the customs law changes, many customs law changes have been introduced by the government, and this has been a trend from the past few years where customs law has been sought to be strengthened in light of the global atmosphere of trade tensions. Government has also, in this regard, sought to strengthen its initiative of Make in India, where they have been consistently following a policy of increasing customs duty rates on imports so as to incentivize domestic manufacturing. First and very foremost change under the customs law is introducing another slew of provisions under the head of administration of rules of origin under trade agreements. So the backdrop of this amendment is important before we move ahead. India has signed many free trade agreements or preferential tariff agreements with various countries. Significant amongst those are Sri Lanka and countries of comprising the Association of Southeast Asian Nations, which are Malaysia, Singapore, Indonesia, and also with South Korea and Japan. Imports from these territories or countries are either exempted or significantly reduced duties applicable. This duties to avail, so for any importer to avail such concessions on customs duty, typically a certificate of origin issued by the authority of the exporting country was accepted. However, various investigations were opened up in the past 2 years by the government, whereby the certificate of origin was sought to be questioned, and the criteria, the usual criteria for ascertaining that a product is indeed genuinely originating from a country from which a trade deal is signed, that is 35% of the value of the exported product should be comprising of as a value addition as taking place in that country itself, was not sought to be fulfilled. So government thought it fit that certain provisions need to be introduced into the customs law itself, whereby the government could be empowered to question the certificate of origin, or where any suspicion is existing, where the 35% criteria is not being fulfilled and still a certificate of origin is being produced by the importer. The provisions are such that now the government can question the importer and make it and compel the importer to produce a lot of information so that this originating criteria can be substantiated. And powers have been introduced where government can suspend this tariff concessions on the basis of information available with them. Earlier, any such action or any such arbitrary action which was proposed, which was taken by the authorities, was quashed by the courts as being outside the scope of the law itself, and this action was also not within the many a times not within the contours of the trade agreement between two sovereign nations. Now the introduction of such powers in the law itself will create conflict between the trade agreement, existing trade agreements between India and other countries, and the provisions which are now sought to be introduced under the law. So it will be interesting to watch how the courts react to these provisions, and it can be assumed that government will be taking an aggressive stance in questioning the tariff concession available under the trade agreements, which were either taken for granted on production of certificate of origin. So again, to sum this provision up is that the government is looking very aggressively to curb the practice of concessional rate of duties, which is there in the tariff agreements. Going ahead, there are customs law changes whereby the government has empowered itself to restrict the import and export of certain goods, where the reason for such restrictions involved injury to the economy of the country. So wherever such reasons were present, the only product which the government had the power to restrict was gold and silver. This power has now been expanded to include any other commodity. However, the government has announced after this introduction of this provision that this power will be used only in exceptional circumstances. The second important change, and again a tightening measure so far as the imports are concerned, is the expansion in the scope of safeguard duty. So wherever the government felt that the domestic industry is being harmed by excessive imports from foreign countries, the power existed in the customs law to impose safeguard duties. However, this has now been expanded to cover safeguard measures as opposed to only duty earlier. So various other measures can be taken by government, including imposition of tariff rate quotas. Another important change relevant for the medical devices industry is that the government is seeking to introduce a 5% ad valorem duty on any medical equipment which is sought to be imported under the chapters 9018 to 9022 of the HSN classification. This is also a measure where government is hoping to are encouraging domestic manufacture of these products rather than being dependent on imports. To sum it up, this provision also is aiming to boost Make in India initiative of the government. Moving ahead, there has been also an expansion in the scope of anti-dumping and anti-dumping duties, for which the powers are already existing under the customs law. The scope of this power is sought to be again expanded, where even when the change in the name of the product happens, or even when the import is sought to be uh, uh, dumped onto India by measures, by practices such as import in unassembled form. On such imports also, government can declare it as circumvention tactics, and anti-dumping duty can be imposed in such scenarios as well. Many changes have been done in the customs duty rates, where the existing rates have been sought to be increased, and wherever exemptions were available on many products have been sought to be removed. Also, a significant announcement in this regard is that from 1st of September 2020, more products will be taken to be reviewed, and duties will be sought to be increased on those products also. Significant amongst the increase in duties are sectors such as solar cells, footwear, gas compressors, refrigerating equipment, and furniture and related products, where the government is seeking to increase a customs duty rate anywhere between 5 to 20% from the existing base rate. Again, this is a measure to increase, to restrict trade and to increase and promote domestic manufacturing of these goods. So here we come to the end of the customs and GST related changes. If you have any questions, you can type it out in the box given, and we'll be happy to answer that.
Thank you very much for your remarks, Nishit and Shivendra. We are now open to questions from the audience. You can put your questions in the chat box on the bottom right of your screen, and our speakers will be happy to address them for you. All right, we have the first question of one of our speakers, which says, is there any tax imposed now by remittances by an individual outside India? Nishit, want to take that up?
Yeah. Yes, so this is the TCS which we spoke about. So if an individual is making remittance under the liberalized remittance scheme, whereby if the remittance in cumulative exceeds $10,000, that is INR 700,000, then there would be a TDS of 5%, TCS of 5%, which the banker would withhold and deposit with the government. This would be available as a credit against the income of that individual. The same can be claimed as a credit.
Thank you for your remarks, Nishit. We have another question coming in from one of our participants. The question is, how is the tax policy for a foreign company selling on an e-commerce portal in India?
So a foreign company selling on the e-commerce platform in India, you will have to first consider the allowability of the same under the Indian Exchange Control Regulation, and also from the new amendment which has come under the budget, you will have now the taxes would be deducted from the payments which you receive from India. So accordingly, you will be liable to file a tax return in India for claiming that withholding as a credit.
All right, we have one more question from one of the participants. This is about TCS on LRS, whether it is also applicable for reimbursement payments to the foreign country.
So the answer to that is it is not applicable. If a company is making a payment for any of its legitimate expenditure, which would be considered as a foreign current account transaction under the Indian FEMA regulations, and hence the TCS provision would not apply on the same.
Thank you, Nishit.
One more question is on the scheme. Okay. So one question is whether what would happen to cases where the matter has been resolved but the penalty proceedings are open. So the scheme states, the dispute resolution scheme states that if there is any penalty proceeding which is going on, then you can pay 25% of the penalty amount and close the matter. And if you paid after 31st March but before 30th June, then additional 10% on that 25% penalty would be leviable.
Thank you, Nishit. A couple of more questions. This probably may overlap with the first one. It mentions, is the newly introduced TCS also applicable for goods?
Yes, so as we said that on sale of goods, TCS is applicable. Only one important point there is that currently there is no exemption provided. So the fear is that even when an Indian company is selling goods to a, say for example, exports outside of India, TCS may be applicable. However, basis the discussions which are happening, it appears that government will come up with an exemption for sales made outside of India. So only for the local sales TCS would apply.
Thank you, Nishit. We have a question on indirect tax. Shivendra?
Yes. So we have a question which asks that whether any credit taken fraudulently or on a, not fraudulently but on a genuine mistake where no invoice is available with the taxpayer, how the credit has been claimed based on a declaration in the form 2A by the supplier. What will be the implication and what will the penalty provisions in such a scenario? Okay, so as we mentioned, to answer this, as we mentioned in the slide itself, that the government is seeking to introduce this this penalty provision only where this fraud has been committed at the behest of the person who is receiving input tax credit. It can be said that on a genuine mistake where the invoice is not available or even when available is lost and still input tax credit is claimed, the harsh penalty provisions under the amended provision should not be attracted.
Thank you, Shivendra. Just to let our participants know, on the bottom right of your screen, you will see a tab called Handouts. We do have some material for you, which is a budget publication and also some information about us and the Indo-Australian Chamber of Commerce. So request you to please download them for your future reference. We have one more question that's just come in. I think, Nishit, this would be for you. Is the abolishing of DDT encourage SME businesses in India to sell out to foreign buyers?
No, actually, right now it may appear that way because what the impression coming out is that the dividend tax rate for foreigners is lower because of the tax treaty protection, whereas for resident individuals it is higher. But we'll have to appreciate that ultimately the dividend which goes outside of India, ultimately that foreign company or the foreign individual would also be paying tax in its home country. So for example, the tax in his home country could be as high as 40 to 50%, depending on the country where the ultimate recipient of the dividend is staying. So from a other country perspective, there is an advantage definitely. So today, even if an Indian investor invests overseas, he would get the tax treaty protection. And unfortunately, the logic or the fabric of the entire system is that the rich pay more taxes. So earlier, what was happening, that a person who was earning 5 lakh rupees as dividend income vis-a-vis someone who was earning as 50 crore as a dividend income, both were indirectly paying the same amount of tax indirectly by way of dividend distribution tax of 20%. But now to bring in equality, the person who is earning only 500,000 as a dividend would not pay any tax, whereas the person who is earning 50 crores as a dividend would pay the highest tax rate. So it is more on the logic of equality as well. So definitely there is no question of moving SMEs, wanting SMEs to change shareholdings or transfer their shares to the shareholders. However, SMEs can actually explore looking at moving to a limited liability partnership structure. This can be looked at from the business perspective, whether feasible, not feasible. We would be happy to discuss this offline as to how LLP structure can be more useful with the new tax regime. Also, option of doing a buyback instead of a dividend distribution can be looked at, because buyback has a 20% tax. So there are other options for SME which can be looked at.
All right, thank you for the detailed explanation, Nishit. I think we have one more question that's just come in from one of our participants. The question says, are there any changes introduced in the SEIS policy because it is valid only from 2015 to 2020?
So, to answer in brief, there is no change proposed to be introduced under the SEIS policy. However, I would like to mention here that the MEIS policy, which is applicable for the goods, is likely to be phased out from 1st April 2020, as India has lost the case in the WTO Council to, and this scheme has been declared as an unfair trade practice, due to which MEIS scheme is slated to be phased out. However, no announcement has been made yet by the government on phasing out or any change in the SEIS policy.
All right, thank you for your comment, Shivendra. Another question which has come in, with regards to educational expenditure remittances outside India, would they fall under LRS and do they attract 5% withholding tax?
The answer to that is yes. Education expenditure sent from India to outside India for kids studying abroad would fall under LRS scheme, and that would unfortunately have 5% withholding now.
All right, thank you so much for your time, Nishit and Shivendra. We hope the audience found the insights shared by our speakers to be interesting and useful. Over to you, Petula and Manisha, for the closing remarks.
Thank you very much. This is Petula here, the Director of the Indo-Australian Chamber of Commerce for India and for our members in Australia. Just 3 points to make. So as we speak, Sanjay Mathur, who is Chief Economist South Asia for ANZ, has sent in his top highlights as well as a full report. And I must say it's quite an impartial analysis. I'll be happy to share that with all those who attended, along with the recorded link of this webinar. I'd also like to thank the SKP group for running this session for us, for their key highlights on new policy schemes with regards to education, MSME, the financial sector, as well as Shivendra for talking about indirect tax implications, and Nishit Parekh for talking about the direct tax implications. Thank you to Viral, Jugal and Manisha for coordinating this. And most of all, to all our attendees, great to see all the questions coming in and for your interaction. You'll soon get an email from us with the recorded webinar as well as with Sanjay's full report. Thank you very much for attending, and we'd love to hear from you. And if this format works, we'd like to do more such things from the chamber, where our members can join us on webinars. Thanks everyone for attending.
Thank you so much. Thank you.